You've probably heard this myth. Buying a building for your business is just like getting a house. It's not. Commercial real estate plays by different rules, and if you know them, you can use them. Quick compare. No fluff. Down payment. Expect 25 to 35% for commercial versus 3 to 20% on a home. Terms. Look at 5 to 20 years, not 30. Balloon payments. Common. When the term ends, the remaining balance is due. Refi or pay it off. Rates. Typically 1 to 2% higher than residential. Underwriting. My business financials matter, not just personal credit. Income. The property has to produce enough rent to cover the debt. Lenders look for that. Types of commercial loans. Traditional commercial mortgage. Bank loan. 5 to 20-year terms. Rates roughly 7 to 10% right now. Balloon typical. SBA 504. If I'm occupying 51% or more, this is the cheat code. Only 20% down. Below market rates. 20 to 25-year terms. If I qualify, it's usually the best deal. Bridge loan, 1 to 3 years, quick close for purchase or renovation, higher rates, then I refinance once stabilized. Construction loan, ground up build, interest only during construction, then converts to permanent financing. Money in. Down payment, plan on 25 to 35%. Owner occupied can be 20%, especially with SBA 504. Investment property often needs 35%. That 504 at 20% down is a big edge. Rates, tied to prime or treasury, fixed or variable. Today I'm assuming 7 to 10%. Investment property tends to price higher than owner occupied. Terms, 5 years. Terms, 7 years. Terms, 10 years. Terms, 15 years. Terms, 20 years. Often amortized over 25 years with a balloon at the end. Translation, refinance or bring cash for the balloon. What gets me approved? Debt service coverage ratio. Lenders want income to exceed annual debt service by at least 1.20 to 1.25x. Business financials, 2 years tax returns and financial statements. Personal financials, net worth and liquidity still matter. Experience. Lenders love borrowers with relevant track records. Property quality, location, condition, tenant quality. Big factors. What I submit. Purchase contract. Property financials, if it's investment. My business financials. Tax returns. Personal financial statement. Rent roll if it's investment. Environmental assessment, yes. Phase 1 is common. Owner-occupied benefits, easier to qualify than pure investment. Better rates, about half to 1% lower. Lower down payment options. And I am building equity instead of paying someone else's rent. Investment property. Tenant strength is everything. Longer leases make financing easier. Lenders underwrite a vacancy factor, and who manages the building matters. The wealth play. I buy a building my business can grow into. Every payment builds equity. As revenue grows and the neighborhood improves, the property value can rise. Eventually, I either have zero occupancy cost with a paid-off building, or I sell and capture the appreciation. Commercial real estate can build generational wealth while housing your business. If the numbers pencil, it's time. Let's buy your building.